Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we will continue with the topic Ind AS 103, that is business combination. This is the fifth lecture on business combination. And friends, if you can recall, in the previous class, we started discussing about specific issues involved in business combination. And in this regard, we take up the next important concept, that is pre-existing relationships. When I say pre-existing relationships, it is possible that prior to acquisition or prior to business combination, the acquirer and acquiree would have some kind of relationship. Maybe one of the party owes to other party. In other words, one party has an obligation to pay to the other and the other party has a right to receive from the other. And this can arise, the pre-existing relationship can be contractual or it could be a non-contractual relationship. Let me explain one thing. Suppose my name is A Limited and I am taking over B Limited. Prior to taking over B Limited, I have sold goods to B Limited on credit and the payment is yet to be received. For me, before this business combination, B Limited was my debtor and that relationship of debtor-creditor has arisen prior to business combination. This is what we call as pre-existing relationship. Now this pre-existing relationship is necessarily a contractual relationship, correct? Because debtors and creditors have emerged out of a contract of credit sale. Now on the contrary, take another example where before taking over B Limited, because of some dispute with B Limited, I have filed a legal suit against B Limited and therefore I have to recover some amount from B Limited. Same scenario, I have to recover some amount from B Limited, but now this relationship which existed before combination was a non-contractual relationship. It has arisen because of a pending litigation in the court of law. Now friends, whatever be the kind of relationship prior to acquisition, what is to be done from the viewpoint of Ind AS 103, that is very, very important. Ind AS 103 is very clear about one thing: any kind of settlement of your dues pertaining to the pre-existing relationship will be taken out of the purview of business combination. That means you settle out all your other payments and receipts separately. Your business combination transaction should not be affected. So the question arises, how should we deal with this situation from the viewpoint of Ind AS 103? So the application of the requirement has to be understood in different scenarios, and we are going to take lots and lots of examples to substantiate this matter, to understand this matter. Let us begin our discussion with simple situations, and the simplest situation could be a debtor-creditor relationship existing prior to acquisition. So please carefully understand the examples that I am conveying to you one by one. I am A Limited and I have taken over another company, that is B Limited, and prior to acquisition I have purchased goods from B Limited. The invoice value of those goods purchased was rupees 5 lakhs, and till the acquisition event that payment has not been settled. That means I still owe to B Limited a payment of rupees 5 lakhs. Now if in my books I have a creditor in the name of B Limited, in B Limited's books there will be a debtor in the name of A Limited. So how do we apply Ind AS 103 in this scenario? Now Ind AS 103 simply ask me one thing: boss, for acquisition of this whole entity, how much did you decide to pay? I said I am deciding to pay a lump sum amount of rupees 1 crore, that's all. The question is, does that 1 crore also include the settlement of that payable? Because in my books there was an outstanding payable, there was an obligation to pay to B Limited a sum of rupees 5 lakhs. In that case, If I say 1 crore is the total lump sum payment, then if that rupees 1 crore includes the payment of that outstanding also, that means overall lump sum payment that I have made including the settlement of that past due is 1 crore. As per Ind AS 103, rupees 5 lakh will be removed out of that rupees 1 crore, and it will be two different transactions that will be considered. Payment is one, but it is a combined payment for two different settlements. One is the settlement of past due 5 lakhs, another is the settlement of consideration for acquisition, which will be the balancing figure, that is rupees 1 crore minus rupees 5 lakhs, that will be rupees 95 lakhs. That means the total payment made 1 crore will be split into two parts, 5 lakhs for settlement of previous dues and 95 lakhs for settlement of consideration. So here you have to be very careful not to let that rupees 5 lakh be part of the consideration for acquisition. If that happens, then the consideration amount will be 1 crore, which is wrong, because if you increase the amount of consideration, it would appear as if you have paid more for acquiring that same business, and it can affect the amount of goodwill that arises on acquisition, or in extreme cases it may affect the gain on bargain purchase that may arise on acquisition. Either ways, the amount of consideration, if it includes the settlement of other transactions, it will be a wrong calculation. Therefore, you have to be very careful not to let those other settlements be part of business combination. So friends, whatever we have discussed, I am going to give you brief notes on the same. Just refer to the screen, and that will be followed by some examples which are made in the form of question answers for you to carefully understand the whole matter. So your attention on screen please. So as we have just discussed about pre-existing relationship, you should write the acquirer and the acquiree may have a pre-existing relationship or other arrangement before negotiations for business combination began. The acquirer shall identify any amounts that are not part of the consideration for the acquisition. The acquirer shall recognize as part of applying the acquisition method only the consideration transferred for the acquiree and the assets acquired and liabilities assumed in the exchange for the acquiree. Separate transactions shall be accounted for in accordance with the relevant Ind AS. Alright friends, you would have finished writing this whole thing. Let us move ahead and apply this concept in solving questions. Let us take up question number 45. On 1/4/2020, A Limited acquires X Limited for a cash consideration that should match with fair value of net assets of X Limited. Prior to acquisition, A Limited had purchased services worth rupees 6 lakhs from X Limited, the payment for which has not been settled till acquisition. On 1/4/2020, assets of X Limited includes rupees 6 lakhs receivable from A Limited towards the same. Fair value of other assets of X Limited was rupees 50 lakhs and liabilities of X Limited were rupees 20 lakhs. The final settlement was done by a payment in cash at the same date. Make necessary calculations and show the recognition made by A Limited for the business combination. So friends, what do we find in this situation? That the two companies A Limited and X Limited, which are involved in this business combination, had pre-existing relationship. One of them was a debtor, another party was creditor. So who has sold services? It is X Limited that has sold services to A Limited. A Limited is the buyer of the service. Because A Limited has not settled this amount yet, it is obvious that in the balance sheet of A Limited there is an outstanding obligation of rupees 6 lakhs. On the other side, the assets of X Limited will include rupees 6 lakhs as receivable from A Limited. Now this is a pre-existing relationship, as what we have discussed about Ind AS 103, such components should not be considered while determining the consideration for acquisition, and business combination should be dealt with separately, and such transactions should be settled separately. So let us see how to deal with this whole situation and how to present the solution. So in your solution, you would first start with the assets of X Limited. The fair value of assets of X Limited, excluding the amount which is due from A Limited, is given as rupees 50 lakhs. Amount due from A Limited is 6 lakhs, which is in the form of receivables. Now, if you look into the aggregate assets of X Limited, including this component of receivable, it is 56 lakhs, and liabilities of X Limited is given as 20 lakhs. Now what will happen? You will arrive at the fair value of net assets of X Limited after considering the amount due from A Limited. So under any ordinary situation, any other company, if it would have bought X Limited, it would have obviously paid a consideration of 36 lakhs. Over here, the matter is something different. Here, A Limited itself is the acquirer, and so what will happen? A Limited will be definitely interested in taking over these assets and these liabilities, but certainly not interested in the receivables due from A Limited. Now, this amount of 6 lakhs of assets, A Limited is definitely not interested to take over. Now, what will happen with this, we will talk about it later, but first of all, one thing is very clear: A Limited is not interested in taking over this asset. So we don't consider this from the viewpoint of acquisition, and therefore the fair value of net assets from the viewpoint of business combination will also accordingly change. It will not be 36 lakhs. So what we now do is, fair value of net assets of X Limited without considering the amount due from A Limited is just 30 lakhs, and now the consideration for acquisition will be 30 lakhs, because as per the requirement in the question, the consideration has to match with the fair value of net assets. So if at all you are getting confused as in what will happen with this 6 lakhs, don't worry about it, I will explain it in a while. Now one thing you should definitely consider, what happens to this 6 lakhs, okay? So basically in this pre-existing relationship between A Limited and X Limited, it was A Limited that had to make a payment to X Limited, correct? So as per Ind AS 103, this amount has to be settled separately, other than the part of the consideration for acquisition. In other words, the consideration for acquisition is 30 lakhs, which A has to pay to X, and this old amount or the pre-existing amount due from the side of A Limited also has to be paid by A Limited to X Limited. So eventually what you will find that A Limited will pay 36 lakhs to X Limited, that is 30 lakhs towards the consideration and 6 lakhs for settlement of old dues or pre-existing dues, and therefore the total payment to X Limited will be 36 lakhs. It is important to identify what will be the recognition entries. The entries that will be passed by A Limited, it will debit assets at fair value, that is 50 lakhs. Then the liabilities will be credited by 20 lakhs, and now the consideration is 30 lakhs. Look into one thing, 50 lakh minus 20 lakh, the fair value of net asset acquired was 30 lakhs. Because the consideration is matching with the fair value of net assets acquired, obviously in this case there will be no amount of goodwill or gain on bargain purchase that will arise. Now we are now going to settle this consideration of 30 lakhs. Along with that, we are also going to make this payment, correct? So don't forget that if it was receivables existing in the books of X Limited, in the books of A Limited there must be a component of creditors, correct, which has to be settled over here. So what you will do is, consideration which you have to now pay, debit that amount of consideration, that is 30 lakhs, and the creditors will also be settled now. So don't forget, once again I am telling you, this creditor represents what? In the books of A Limited, this is an outstanding liability which is due to X Limited. At the time of settling the consideration, you have to also settle this amount. However, these two are two separate transactions. this is settlement of pre-existing relationship, and this is settlement of consideration towards business acquisition. And finally, the total payment to be made will be 36 lakhs. Let us move ahead and now take up another scenario, the reverse scenario, and that will be given in question number 46. Let us read this question. On 1/4/2020, A Limited acquires X Limited for a cash consideration that should match with the fair value of net assets of X Limited. Prior to acquisition, X Limited had purchased services worth rupees 6 lakhs from A Limited, the payment for which has not been settled till acquisition. On 1/4/2020, liabilities of X Limited includes rupees 6 lakhs payable to A Limited towards the same. Other liabilities of X Limited were rupees 20 lakhs. Fair value of assets of X Limited was rupees 50 lakhs. The final settlement was done by a net payment in cash at the same date, that is 1/4/2020. Make necessary calculations and show the recognition made by A Limited for business combination. So friends, we find again a similar kind of situation with just an opposite scenario given, that prior to acquisition, X Limited and A Limited had some existing relationship, and that existing relationship was of this type, where X Limited has purchased services worth 6 lakhs and the payment is outstanding. So in this scenario, it is X Limited which is the debtor. That means X Limited has an obligation to pay. That means in the balance sheet of X Limited, this amount will be appearing as a payable, and it will be balance sheet of A Limited where this amount will be recognized as a debtor or receivables. So let us see how to present the solution in this case. In your solution, you are first going to again consider the fair value of total assets of X Limited, that is 50 lakhs. Liabilities other than the amount due to A Limited is 20 lakhs, and the liabilities which represents due to A Limited is 6 lakhs. So if you again calculate, you will find that the net assets of X Limited will be 50 lakhs minus both of these liabilities. That means 50 lakhs minus 20 lakhs minus 6 lakhs, it will come to 24 lakhs. However, you know one thing, that A Limited is not interested in taking over this liability, correct? So A Limited is not going to take up the amount that represents an outstanding out of a pre-existing relationship, that will be settled separately. As a result, you are not going to consider the fair value of net assets as 24 lakhs because you have removed this component. Now you will take only 50 lakhs minus 20 lakhs. So 24 lakhs will not be the case. Fair value of net assets of X Limited that you have to now find out should be without considering the amount due to A Limited, and that will be 30 lakhs. Consideration for acquisition has to match with 30 lakhs. So you just write consideration for acquisition as rupees 30 lakhs. So friends, again what happens to that other 6 lakhs, it will be settled separately, though it will be a part of the net payment, but still from the accounting viewpoint it will be settled separately. So how to deal with that component, we will talk about it. Let us move ahead and see how the settlement will eventually take place. So what will happen now? Settlement by A Limited, it will first of all have a liability towards X Limited for settlement of this consideration. However, there was a pre-acquisition due which was a due from X Limited payable to A Limited. So obviously it is not going to happen that A Limited will first pay 30 lakhs and then recover 6 lakhs. On a net basis, a settlement will take place in cash. So the net settlement will be of rupees 24 lakhs, and finally net payment to X Limited, which is 24 lakhs, is net of these two amounts, one which is due to X Limited on account of consideration for acquisition, and one which was receivable from X Limited for a pre-existing relationship. The net amount will be settled in cash, that is 24 lakhs. Let us see how to pass the accounting entries for the same. In this case, what you will do, first you will record the assets and liabilities of X Limited at their respective fair values. Along with that, you will also make the consideration due. Once this is done, you will settle this consideration, that is 30 lakhs, but not paying 30 lakhs, you will pay only 24 lakhs. So don't forget that if it was a liability in the books of X Limited, it must be receivable in the books of A Limited. that receivable has now been recovered for settlement of this consideration. As a result, the amount of the debtors or receivables which are existing in the books of A Limited will now be written off against this consideration. So final settlement entry will be what you find on screen. Let us now take the matter a step ahead. Now, what we have seen in this example was indeed an example of a pre-existing relationship, which was a contractual relationship, correct? And contractual relationship because it is a case of debtor-creditor settlement, and debtor-creditor emerges out of a contract and hence a contractual relationship. So pre-existing relationship, which was a contractual relationship, both the parties kind of knew how much is going to be the amount of settlement. Means A Limited knew how much I have to pay to B Limited, B Limited knew how much it has to recover from A Limited. However, when it is a case of a non-contractual relationship in the form of a pre-existing relationship, the matter could be different. So let us take a little different example now. I am A Limited, I am taking over business of B Limited. Prior to this business combination, B Limited has legally sued A Limited in the court of law, claiming damages of rupees 20 lakhs because of some fault in contract made from A Limited. A Limited is being sued for damages of rupees 20 lakhs. However, A Limited disputes the claim. According to A Limited, even if it is at fault, the maximum amount of claim should be rupees 8 lakhs. Now, in between, some days back, when it was an year end, 31st March, A Limited has made a provision of rupees 8 lakhs, which was the best estimate of that liability towards that claim as per the estimation of A Limited. Now, B Limited has not made any recognition of this because from the viewpoint of B Limited, it is as good as a contingent asset, and contingent asset would not be recognized. But it is still expecting to recover 20 lakhs from A Limited. Now, this was the story prior to acquisition. I finally put a proposition to B Limited that, boss, let us do one thing. I give you a lump sum amount of 1 crore and you just give away your entire business to me. That's all. Somehow B Limited agrees. For a lump sum payment of 1 crore, it is agreeing to leave everything including that claim. That means this 1 crore what I am paying to B Limited is not only for acquiring its business but will also cover up the past settlement of that old claim. However, as per Ind AS 103, I am not supposed to consider this 1 crore as consideration for acquisition. As per Ind AS 103, the settlement of that old claim should be treated as a separate transaction and it should be recognized at its fair value. Now, somehow by this date of acquisition, A Limited evaluates that, boss, if this goes to be finally settled by court, court will ask me to pay 20 lakhs. That means the fair value of that liability, I repeat, the fair value of that liability as at the date of acquisition is rupees 20 lakhs. I have recognized this liability earlier at just rupees 8 lakhs. Now I have to increase the balance of that liability and that differential would be a loss to me. Now here I have to remeasure that liability at its fair value, and finally how will the settlement take place? The fair value of that liability is 20 lakhs. Total amount paid by A Limited to B Limited is 1 crore. That 1 crore includes that settlement claim of rupees 20 lakhs. Remove it. So purely the consideration towards acquisition will be rupees 80 lakhs only. That is rupees 1 crore minus rupees 20 lakhs. So when you are passing the recognition entry in the books of A Limited for recording all the purchase of or acquisition of assets and liabilities of B Limited, the consideration that you consider must not be any amount other than 80 lakhs, and then the balance payment of 20 lakhs should be treated as a separate transaction. And because you have already recognized, I mean, I'm talking from the viewpoint of A Limited has already recognized that liability amounting to rupees 8 lakhs, the excess amount that it had to pay, that is difference between 20 lakhs and 8 lakhs, that is 12 lakhs, will be charged off as a loss to P&L by A Limited. So friends, understand one thing, when there is a pre-existing relationship which is non-contractual, most cases some or the other amount of gain or loss will be recognized by the acquirer, and that will be definitely recognized as a separate transaction. Any receipt or payment in regards to that will be treated as a separate transaction and will not be part of business combination. So friends, whatever we have discussed, let us take that matter ahead and let us put those examples in the form of question answers so that you can have much better understanding. So let us go ahead with questions. Let us take up question number 47. Let us read this question. During December 2019, Ajanta Limited, a pharmaceutical company, was sued by another pharmaceutical company, Nupin Limited, for breach in a supply contract. The legal claim raised by Nupin Limited was rupees 10 lakhs. On 31/3/2020, Ajanta Limited made a provision for rupees 6 lakhs towards this. However, Nupin Limited did not recognize any asset towards this claim. On 1/4/2020, Nupin Limited acquires Ajanta Limited for a consideration to be settled in cash amounting to rupees 62 lakhs net of the legal claim. On that date, the estimated fair value of the expected settlement of claim was rupees 10 lakhs. Other liabilities of Ajanta Limited were rupees 20 lakhs. Fair value of assets of Ajanta Limited was rupees 90 lakhs. How the recognition will be made by Nupin Limited for this business combination? So friends, let us first analyze the whole situation. Can you see in the last paragraph of the question, they have given assets and liabilities of the acquiring company Ajanta Limited other than the amount of that claim, correct, excluding that claim. Now the claim amount at fair value is rupees 10 lakhs, whereas Ajanta Limited has made a provision of only rupees 6 lakhs. So first of all, this claim is payable by Ajanta Limited and receivable by Nupin Limited, and this time Nupin Limited itself is the acquirer, and it is obvious that Nupin Limited will not record that receivable because from the viewpoint of Nupin Limited, that amount is a contingent asset. Now friends, you can see one thing, that the agreement to settle the whole matter was by making a cash payment of 62 lakhs. Look into one thing, 62 lakhs is the consideration net of that claim. Now see what is happening. Suppose I am Nupin Limited, I have made a legal claim to Ajanta Limited. From Ajanta Limited, I have to recover 10 lakhs, correct? I have not recognized a single rupee of that asset. I have yet to receive 10 lakh rupees from Ajanta Limited towards that claim, and on a net basis I am making a settlement of 62 lakhs. The question is, how much should be the consideration? Now what amount has been recognized by Ajanta Limited as a liability, I am not concerned with that. The acquirer has nothing to do with the carrying amounts of those liabilities with the acquiry. I have to look into what is the fair value of the claim. Fair value of the claim is 10 lakhs, that is given in the question. Secondly, question also specifies that the net amount settled is 62 lakhs. So actually what will happen, I had to receive 10 lakhs and I have not received that amount. Instead, I have purchased that whole business by making a net payment of rupees 62 lakhs. So it will be some amount receivable, some amount payable, and the net amount was settled. That net amount is 62 lakhs. So guess what would be the consideration for acquisition? The answer is simple. The consideration for acquisition must be 62 lakhs plus that claim, that is 62 lakhs plus 10 lakhs, that is 72 lakhs. If you don't understand why it will be 72 lakhs, try to follow one more thing. Keep both the transactions separate first of all. Assume that I have acquired that business, I am Newpin Limited, I have acquired business of Ajinta Limited and I have to make a settlement of consideration of 72 lakhs. Now I am not considering that claim amount at all. And for the claim settlement, I have to receive rupees 10 lakhs from Ajinta Limited. So I have to receive 10 lakhs, I have to pay 72 lakhs. So net payment will be obviously 72 minus 10, that is 62 lakhs. Question did not tell you the proper amount of consideration. It has indeed given you the net amount of payment in terms of settlement of everything. That means it is a net settlement amount. It is not the amount of consideration. Net settlement amount obviously will be 62 lakhs. Think practically, two companies transacting with each other. Do you think that one company will make payment of 72 lakhs and then it will receive a cash payment of 10 lakhs? No, there will be one singular payment in most cases. However, from accounting viewpoint, you cannot merge it, you cannot club it, you cannot consider rupees 62 lakhs in this example as consideration. So the amount of consideration will be rupees 72 lakhs that Newpin Limited has to pay to Ajinta Limited, and Newpin Limited has to recover that claim from Ajinta Limited amounting to 10 lakhs. So 72 lakhs payable, 10 lakhs receivable, net amount payable will be 72 minus 10, that is 62 lakhs payable to Ajinta Limited. So I repeat again, this question did not give you the amount of consideration, it has given you the net amount payable for the net settlement of everything all inclusive. So friends, you have to figure out the correct amount of consideration in this case. So it will be 62 lakhs of net settlement. To that you will have to add the amount of claim, and the fair value of that claim will be rupees 10 lakhs. 10 lakhs added to 62 lakhs, 72 lakhs will be the outcome, which will be the consideration for acquisition. Now next thing that you should be very clear with, when Newpin Limited is taking over all assets liabilities of Ajinta Limited, from Ajinta Limited it will not take over that component of liability that it has recognized, because that represents the same amount that is recoverable by Newpin Limited, correct? So those mutual balances, those pre-existing relationship old balances will not be taken, it will be settled separately. And here what will happen in the books of Newpin Limited? In the books of Newpin Limited, not a single rupee of that receivable was identified or recognized earlier. When it is now being settled and it is a claim which is being receivable, you will consider the entire amount as a gain and transfer it to P&L at the date of acquisition. In fact, what you can do is consider that 10 lakh of claim recognition prior to making this business combination, so that you are very clear that 10 lakh is receivable, 72 lakhs is payable, net payment 62 lakhs. So friends, let us see how to present the solution for the same. In the solution, what you would do is you would start with the fair value of assets of Ajinta Limited, that is given as 90 lakhs. You will consider its liabilities also, that is 20 lakhs. Now its liabilities have two components, one which is amount due to Newpin Limited, which they have recorded as 6 lakhs, and other liabilities are 20 lakhs. So as such, if you look into the net assets of Ajinta Limited, it will be 90 lakhs minus 20 lakhs minus 6 lakhs. Its net asset what they have recorded is 64 lakhs. However, we are very clear that Newpin Limited is not interested in this component of liability, correct? So according to Newpin Limited, what will happen? It will just consider these two components of assets and liabilities. It will not consider the amount which is due to Newpin Limited itself. So if you eliminate this amount from the view, what will happen? Obviously this amount would change. So what we get now is not 64 lakhs, but the fair value of net assets what we get after eliminating that liability as 70 lakhs. So 90 lakhs minus 20 lakhs will give you 70 lakhs. Let us move ahead and look into the calculation of goodwill that will arise on the acquisition. So final payment to Ajanta Limited net of claim, it is 62 lakhs. I have already explained you, this is net of that claim and the fair value of the claim is rupees 10 lakhs. So what we can consider is that this 62 lakhs is after subtracting the payable amount of 10 lakhs, correct? So if this is net of claim amount that Ajanta Limited had to pay to Newpin Limited was 10 lakhs and this 62 lakhs is obtained after subtracting that 10 lakhs. That is why to get the original proper amount of consideration, you are going to add the fair value of that legal claim, that is 10 lakhs, and so the consideration for acquisition will be 72 lakhs. Now from this consideration, you subtract the fair value of net assets of Ajanta Limited and what you would now get is goodwill arising on acquisition as rupees 2 lakhs. Let us move ahead and look into how Newpin Limited will make this recognition of business combination. So first of all, it will record a new asset at this date, that is claim receivable, because this was not recorded by Newpin Limited earlier. And against this recognition of receivable amount, it will directly recognize a gain in the statement of P&L. So you would say recognition of gain on claim receivable. Thereafter, what it will do is it will record the assets and liabilities of Ajanta Limited. Assets were 90 lakhs, goodwill was 2 lakhs. We have seen the calculation of goodwill. Liabilities were 20 lakhs, and against this the consideration for acquisition is rupees 72 lakhs, and you would write recognition of net assets acquired. Finally, when you settle this consideration, make sure of one thing, that you are settling the consideration of 72 lakhs by paying only 62 lakhs, because you definitely will also square off the claim receivable. So the last entry for settlement that you will pass will be consideration debit 72 lakhs, to bank 62 lakhs the net payment, and to claim receivable 10 lakhs. So finally your claim receivable has been cross cancelled against the amount of consideration payable, and that is how the net payment of 62 lakhs has been recorded through bank. Let us move ahead and talk about the next concept, that is reacquired rights. Now let me remind you, we are still talking about pre-existing relationship. That means a relationship existed prior to acquisition between the acquirer and the acquiree, but of a little different type. Here we are talking about rights which have been reacquired along with the business acquisition. So let me explain this by way of giving an example. Suppose I am A Limited and I operate a food joint with a popular name, Bite Me. Now this brand is so popular that throughout the town there are lots of eating joints with this brand name. Some of these are my own branches and some of these are my franchisees. That means these other operators who are franchisees, they have paid me a fees for using the brand name. Now suppose at a particular location in the town, a franchisee is doing a fantastic business and I find a potential in acquiring that business. I would just pay a price and acquire that entire business. Now what will happen? Along with that business, the franchisee rights will also come back to me. If that is the case, I will not get that thing free of charge, because at the time of providing the rights to use my brand name, I have charged a fee, and when I take back that right, I have to pay some penalty, because under a franchise agreement there will be definitely a clause that what if there is a cancellation of this arrangement, if I cancel that arrangement I will have to pay back some amount as penalty. So generally what happens, for the unexpired period of the contract, whatever be the proportionate amount of franchisee fee, that plus or minus some percentage will generally be the amount of penalty. So that penalty will be stated in the contract. Now friends, what gets little complicated over here is the requirement of Ind AS 103. You have to understand it very well, because something wrongly applied will mess up the whole calculation and accounting. So let us move ahead step by step and let me give you lots of examples. So assume that I have charged a fee of 5 lakh rupees for giving the franchisee rights, giving the rights to use my brand name. Now I am reacquiring that. As per the contract, whatever be the unexpired period, for that I have to pay the proportionate fees back along with 20% extra. Now what happens, 5 lakh was charged for a period of 5 years. So proportionately it is 1 lakh every year, right? Now after giving the franchisee rights, 2 years have been passed. That means the unexpired period of the franchisee agreement is still 3 years. So proportionate amount for 3 years would be 3 lakhs. Now as per the arrangement, if I take back the franchisee rights, I have to give 3 lakh plus 20% extra. That means I have to pay 3,60,000, and I am willingly paying that 3,60,000 because I find a big potential in that particular franchisee. Now I have to consider the closure of the franchisee rights as a separate transaction, correct? So because it's a closure of franchisee rights, it is a separate transaction. It was a pre-existing relationship which I would want to settle, and as per Ind AS 103, whatever payments I make for that will be considered as a separate transaction, and that charge what I pay will be charged off to P&L. But here you have to be little cautious about these calculations. Now assume that the fair value of that franchisee right is 15 lakhs for that unexpired period. That is why I am so much interested, right? That means if someone is given this kind of right, the present value or the fair value of that right today for the unexpired period of 3 years would be 15 lakhs, whereas I have charged a very small amount of fee. So I am going ahead and cancelling that right. I am taking back that right by paying 3,60,000. So amount what I am paying is substantially lower than the fair value of that right. So Ind AS 103 requires certain amount to be charged off as a loss in the statement of P&L towards this reacquisition of right. That amount should be the difference between the fair value and the proportionate unexpired carrying amount. Let me explain that. So I just said 15 lakh is the fair value of that right today, and if I look into what is the proportionate fees for the unexpired period, 5 lakh was for 5 years, so it is 3 lakh for 3 years. So if you can look into one thing, I have charged just 3 lakh for those remaining 3 years, whereas the fair value of that right is 15 lakhs. That means I am incurring a loss of 12 lakh rupees towards that franchisee arrangement already, because today if I give this fresh right to someone, I would have charged 15 lakhs, whereas earlier I have charged proportionately 1 lakh per year only. Now the point is very simple, that difference is 12 lakhs, 15 lakh minus 3 lakh. So let me once again tell you what was that 12 lakh. 12 lakh is the difference between the fair value of that right and the proportionate carrying amount for the unexpired period. So it is basically 15 lakhs fair value minus proportionate carrying amount, that will be 5 lakh into 3 by 5. 5 lakh into 3 by 5 will make it 3 lakh. 15 lakh minus 3 lakh is 12 lakh, with which I am already finding this existing relationship unfavorable for myself. However, to get it back, I have to make a payment of just 3,60,000. That is 3 lakh, the proportionate amount for the unexpired period plus 20% extra. 3,60,000 I am giving as penalty. Now, what will happen? I have to compare the earlier amount, that is 12 lakhs, and this 3,60,000. Whichever is lower will be considered as a loss to me for reacquiring the rights, and that amount should not be part of the consideration for business acquisition. It should be a separate transaction. That means the fair value of the rights reacquired is 15 lakhs, but the amount that I am paying for that is just 3,60,000. And how much amount should I consider as a charge to P&L as a separate transaction is lower of two amounts, lower of 15 lakh minus 3 lakh, that is 12 lakh, or the penalty paid, that is 3,60,000. Lower of these two is 3,60,000. So whatever lump sum consideration I have paid to the franchisee for buying the whole business, inclusive of the charges for reacquired rights, from that lump sum payment I shall subtract 3,60,000. From that, if I subtract 3,60,000, the remaining amount will indicate the purchase consideration, and that 3,60,000 will be a separate transaction cost which will be charged to P&L on account of reacquired rights. Now friends, in exceptional case, suppose, just suppose, the amount that I have paid as a penalty, suppose it was not 3,60,000, but suppose it was 18 lakhs, a big huge amount, correct? This time between the two, that is between amount of penalty paid 18 lakhs and the difference between those two amounts, that is 15 lakh minus 3 lakh, 12 lakhs, 12 lakh and 18 lakh, when I compare, it is 12 lakh which is smaller amount, right? In such case, as per the requirement of Ind AS 103, what I will charge off to P&L will be lower of 12 lakhs and 18 lakhs. So I will charge off only 12 lakhs to P&L for reacquiring rights. So from the entire amount of consideration, only 12 lakhs will be reduced. That means out of 18 lakhs, only 12 lakh has been separately considered. Balance 6 lakhs will still remain as part of the consideration. So friends, be very clear what you have to do. You should find that when you are reacquiring those rights, you will have to charge some amount to P&L. Now what is the amount that you will charge to P&L? It is lower of two amounts. Which two amounts? Number one, the unexpired period, whatever be the unexpired period, for that what is the fair value of right minus what is the carrying amount of right. So fair value minus carrying amount, that differential, one amount. Second amount is the penalty that I have paid for reacquiring the rights. Between the two, whichever is less should be first found. Thereafter, from the total consideration inclusive of the charges paid for reacquiring the rights, you should subtract that amount which was lower of the two. That lower of the two amount will be subtracted from the consideration and separately charged to P&L as a separate transaction cost towards reacquired rights. And after subtracting that from the gross amount, the net amount what you get should be considered as consideration for business acquisition. Now friends, this whole matter I will be providing you systematic notes, and you will write down those notes also very properly. Don't be lazy, write everything properly so that you can retain it for longer time. Now when you are writing these notes, you will follow up the next few questions which are based on this reacquired rights, and once you are clear with this whole concept, then we move ahead. So friends, let's approach this whole thing step by step. Your attention on screen, first notes and then questions. So what we have just discussed about reacquired rights, as part of a business combination, an acquirer may reacquire a right that it had previously granted to the acquiree to use one or more of the acquirer's recognized or unrecognized assets. Examples of such right include a right to use acquirer's trade name under a franchise agreement or a right to use acquirer's technology under a technology license agreement. A reacquired right is an identifiable intangible asset that the acquirer recognizes separately from goodwill. If the terms of the contract giving rise to a reacquired right are favorable or unfavorable relative to the terms of current market transactions for the same or similar items, the acquirer shall recognize a settlement gain or loss. Let us move ahead and write some additional important points. Further, Ind AS 103 provides that if the business combination in effect settles a pre-existing relationship, the acquirer recognizes a gain or loss measured as follows. For a pre-existing non-contractual relationship such as lawsuit, fair value. So we have seen this fair value examples earlier, correct? Now, for a pre-existing contractual relationship, the lesser of 1 and 2. Now, 1 is the amount by which the contract is favorable or unfavorable from the perspective of the acquirer when compared with the terms for current market transactions for the same or similar items, and second, the amount of any stated settlement provisions in the contract available to the counterparty to whom the contract is unfavorable. Let us move ahead and apply this concept in solving some questions. Let us begin with question number 50. On 1/4/2019, MacDuck Limited granted rights for using its brand name MacDuck to one of its franchisee Junk Food Limited for 5 years. Junk Food Limited paid rupees 10 lakh as franchise fee. It was also agreed that in the event of withdrawal of rights before 5 years period, MacDuck Limited would pay penalty at 120% of franchise fee for the remaining period. On 1/4/2020, MacDuck Limited acquires Junk Food Limited for a cash settlement of rupees 61,20,000 including penalty. Fair value of net assets acquired in the business combination was rupees 31,20,000 excluding the reacquired rights which had fair value of rupees 18 lakhs. Explain how MacDuck Limited will recognize this business combination. So friends, first of all, what you need to do is apply theoretically the concept that we have learned. So look into one thing. The franchise fee paid was rupees 10 lakhs and it was paid for a period of 5 years. So proportionately it works out to rupees 2 lakhs every year. The date on which the right was granted was 1/4/2019 and the date on which the right was taken back along with the business acquisition is 1/4/2020. So we can see that just after 1 year of granting the rights have been reacquired. So the unexpired period of the franchisee rights is 4 years. So the proportionate amount of this franchisee fee for 4 years would be 10 lakh into 4/5 or simply 2 lakh multiplied by 4 years, and that would give you rupees 8 lakhs. For taking back this right, the acquirer will have to pay 120% of that unexpired amount. That means 120% of 8 lakhs, that means it will be 9,60,000. Now that 9,60,000 is included in this, right? Because this consideration which is being paid for settlement includes that penalty. That means 61,20,000 includes 9,60,000 also. However, how much we will subtract from this, whether it is 9,60,000 or some other amount, depends upon that comparison. So when we are solving this question, we will pay specific attention to this point, that how much will be subtracted out of this. So let us see how to go ahead and present the solution. In your solution, what you would first write is, as per Ind AS 103, a reacquired right is an identifiable intangible asset that the acquirer recognizes separately from goodwill. If the terms of contract giving rise to a reacquired right are favorable or unfavorable relative to the terms of the current market transactions for the same or similar items, the acquirer shall recognize a settlement gain or loss. The penalty paid for reacquired rights is not part of consideration towards business combination. Such penalty will be as follows. It is 120% of 10 lakh into 4 by 5 years. So I have already explained this to you. It will be 9,60,000. Now whether 9,60,000 will be charged to P&L or some other amount, we have yet to figure it out. Let us move ahead and make the other calculations. First of all, the reacquired right is recognized at rupees 18 lakhs, that is the fair value for the remaining contractual life. So you should understand one thing, irrespective of how much penalty is paid, the amount that will be recognized will be the fair value of that right, and the fair value of the right is given as 18 lakhs. On the other side, the loss on settlement of contract will be lower of the two amounts. One amount could be the difference between the amount that MacDuck Limited could receive for granting a similar right, that is rupees 18 lakhs, compared to the carrying value or the unamortized value that was granted for, and that is 8 lakhs. How we get 8 lakhs? You have learned that it will be 10 lakhs, the total value or the total fees for 5 years into proportionate period of 4 years remaining out of 5 years, and that will be 18 lakh minus 8 lakhs, that is 10 lakhs. Let me explain you this point first of all. So if MacDuck Limited would have granted this right at this moment, at this point of time, the fair value of that right is 18 lakhs. It could have received 18 lakhs. However, for the remaining period of 4 years, what it has actually received is only 8 lakhs proportionately. So loss that it is incurring right now is 10 lakhs. On the other side, the amount paid to eliminate this loss is 9,60,000 only, which was paid by way of penalty. That is why not 10 lakhs but lower of these two amounts will be considered as loss to this company. So you can say that the loss on settlement of the contract will be lower of these two amounts, that will be 9,60,000. Let us move ahead and determine the amount of goodwill that might arise on this business combination. So total amount payable to Junk Food Limited, it was 61,20,000. Now you should understand one thing very well. This amount includes the amount of penalty paid, and penalty paid was 9,60,000. However, what you subtract from this should be the lower of those two earlier amounts which you have to charge off to P&L. In this case, it was the same amount that was the penalty, and that is why we subtract that. 9,60,000 subtracted. One thing, once again I am telling you, this was lower of the two amounts, correct? If this was not the lower of the two, you would have subtracted the other amount. Anyway, right now subtracting this, the consideration what you get now is 51,60,000, which will be consideration for acquisition. Compared to this, the fair value of net assets acquired other than the rights were 31,20,000, and the fair value of reacquired rights, it is 18 lakhs. Subtracting both of these from 51,60,000, you still find some excess payment which will be considered as goodwill arising on acquisition. Let us move ahead and write up the accounting entries for recognition at the acquisition date. Net assets excluding rights at fair value 31,20,000, reacquired rights again at fair value 18 lakhs, goodwill as we have determined above 2,40,000, and the consideration against all this is 51,60,000. So by the amount of consideration, Junk Food Limited has been credited at 51,60,000. Now an additional credit of 9,60,000 will be provided against cancellation penalty. And can you now notice one thing, that in both of these entries, Junk Food Limited has been credited by 51,60,000 and 9,60,000. This is towards consideration and this is towards the cancellation penalty. So aggregate of these two will be the amount of settlement, that is the total payment 61,20,000, and once it is paid, the cancellation penalty will be charged off to P&L, because that being an outflow and not forming part of the consideration. So friends, please record all these entries and that will be end of the solution.